Lockheed Martin is down 10% over the last 12 months, so is it a very good time to buy this company at an attractive price? Is it one we should consider for the portfolio? As always, we'll look at the historical performance of the company. We want to analyze their revenue growth year on year as well as their bottom line net income. We will look at the health of this company, their total cash versus their total debt, and we want to see how well they're performing against others in this industry over the last 10 years. We also want to ensure that the dividend does look to be safe. We'll run through a lot of financial metrics, the free cash flow, the net debt, and as always, we'll look at both insider ownership as well as institutions to understand what they're doing. And in today's episode, we will take a little sneak at their outlook for the full FY24 and understand why this massive investment management company did recently sell LMT. Now, don't forget, we are going to run them through the intrinsic value calculator so we get to their value as well as their acceptable buy price given our investor margin of safety and see what Wall Street are forecasting as a price target for 2024. Now, in terms of the historical performance of this company, what we can see is that whilst they are down around 10% over the last 12 months, year to date, they are essentially pretty much flat. Over the last 5 years, they are up around 49%. And if you've been a shareholder over the last 10 years, you would be up 196%. Bear in mind, this doesn't include dividends reinvested. So if you were reinvesting your dividends, it would be a slightly higher percentage. And right now, we do note they are in the midpoint of the 52-week range. And we can see they do offer a yield of 2.79%, a forward PE just above 17, and a market cap of 109 billion. Now, when we look at companies, we look at a lot of them. We do look at their revenues. Different companies, we have different expectations. For Lockheed Martin, as a general company, we do want to see 3 to 7% growth year on year. What we note is they increased their top line from 40 billion 10 years ago, December 2014, to around 68 billion in 2023. So we can quite clearly see they have increased their top line. Now, when we do look at it from a graphs perspective, it is moving in the right direction year on year, as we can see. But there are some years, notably 2021, where it did drop into 2022, although it has always rebounded to move in the right direction. So overall, this is a company that is increasing their revenue the right way that we expect, always moving forwards over a longer time period. And in terms of the bottom line, when we analyze it, 3.6 billion in 2014. They have nearly doubled that in 2023 at 6.9 billion. Although what we do want to point out is that their bottom line is a little bit more inconsistent. Whilst over the longer term it is increasing, we do notice some years where it does fall, 2017 as well as 2022. Overall, however, the long-term growth of this company on the top line and bottom line is looking positive and what we are expecting from a company in this industry. Now, quick look at the health of this company. 1.4 billion of cash and short-term investments in 2014. Near enough the same in the latest quarterly report. No real worries with that. We can see their cash balance is very, very inconsistent year on year. But again, it isn't something that is necessarily a red flag indicator. And when we take a look at their total debt numerically and directionally, we can see whilst their cash has pretty much remained the same, their total debt is up 3 times from 6 billion in 2014 to around 18.6 in the latest report. Now, it isn't again a red flag indicator. We do know they do have a fairly high debt level in comparison to their total cash, but we will analyze shortly their net debt to EBITDA to understand how badly that affects the dividend, if at all. So overall, looking fairly strong on their financial statements. When we take a look at their performance versus competitors in the aerospace and defense industry, Boeing, Safran, RTX Corporation, General Dynamics and Airbus, we can see over the last year, now this includes total return, so dividends reinvested, they are one of the worst performing, down 7%, only better performing than BA, down 14%. When we extend it to the last 5 years, we can in fact see it is the second best performing, up 70%. And when we extend it over the last 10 years, for those that have been a shareholder, we can see in fact it is one of the best performing, up 282%, which is a fairly decent return over a 10-year period. But as always, we can see over the period, over 1 year, one of the worst performing, over the 5 years, second best, and over 10, the best performing, that it does go through different phases. But over the long run, what we can note with this company, it is strong. But as always, do bear in mind, past performance is never an indicator of future performance. Now, in terms of looking at their growth rate, we do get an overall grade of D, not the greatest. It is very mixed when we look at some comparisons. Year-on-year growth, 2.41%. Bear in mind the sector median sits at 6%, so it is lower than that. Their forward growth rate, which we will touch upon from their guidance, 2.85, again lower than the sector median. The positives that we can note here, however, is that their EBITDA growth year-on-year is double digits, very strong, higher than the sector median, as well as their EBIT growth as well. But do bear in mind, in terms of their top line growth, they are lagging behind the industry. Now, in terms of looking at their profitability, so we have an A+ grade right now. The only area that they do really lack is their gross profit margin, coming in at 12.7%, which is pretty poor when you consider the median in the sector is 31%. Other than that, the EBIT margin, very strong, 13.4%, higher than the 10%, and the bottom line net income coming in at 10.24%, significantly higher than the sector median. So in terms of profitability, looking strong, although we do note the gross profit margin isn't that great when we compare it to what others in the industry are performing. Now, before we jump into the dividend safety, let's have a quick look at the insider ownership. 0.14%. Now, we do note a lot of insider selling over the last 12 months. 8.42 million versus around 500,000 worth of buyers in the same period. The largest of these coming in Q1. Now, we can take a note and understand where this is coming from, but we have an insider as well as the S financial president as well as the COO selling in March. All three of them, we can see 2.8 million from the COO, 1.7 million from the SVP, and an insider of around 2.7 million. Now, one thing that I do want to make clear is insider selling is not a bearish signal, as we also don't know why these insider sells, but it is quite interesting to see that quite a few members of insiders have sold. We do know, however, a US Congress member did buy at the back end of 2023, and in terms of the latest insider buying, you have to go further back to around the 19th of July. Now, in terms of institutional ownership, well, what we see here is 74.2%, 9 billion worth of sales versus 7 billion worth of buys, so quite a bit more worth of selling by the institutions. However, in the more recent quarter, Q1, we do note here a lot more buying, 159 million versus 17, but we also want to make clear, we want to be transparent. Q4, Q3, Q2, Q1, every single quarter in 2023, institutions were selling more shares than buying. So take it with a pinch of salt. Also, always do your own due diligence. Never copy what the institution's doing, but it is quite interesting to pick up on that theme. Now, one thing we do want to point out is that we did release our latest free weekly article. If you want to gain insight into 10 undervalued dividend stocks for your portfolio, completely free, do click on that pinned comment below. And you can also gain access to a lot of other articles that we have produced on our weekly newsletter. Now, one thing we do want to run through is this 2024 outlook, which is quite important. The reason for this is when we look at their sales, they are expecting 68.5 million to 70 million in FY24. The reason why we want to highlight this is because when we go and look at how they performed in FY23, they had around 67.571 million. So they are expecting growth, although very minimal in FY24, with a maximum target of around 70 billion. However, one thing that they are anticipating, as we can see from their diluted earnings per share, that it will be lower than the previous year, between 25.65 and 26.35. When we do look at the last year's diluted earnings per share, 27.55. So they're not expecting that to be higher than their current year. In terms of one thing that we do quite like is they are looking to do around 4 million worth, or in fact 4 billion worth of share buybacks. So that will return some of that excess cash to investor pockets that we will touch upon as well when looking at the metrics. Finally, we just want to talk about a recent fund that did sell Lockheed Martin Corporation. It is Vieltefer Fund. Now, this is an investment management company. They do release quarterly investor letters. And in their latest one, they do talk about a few stocks. One of them being the one that we have got under the spotlight today. That is Lockheed Martin Corporation. It is one of them that they sold. Now, they do talk about how the share price of this company did reach some very strong numbers when Russia invaded Ukraine in 2022. You have to go back now around 2 years ago. Now, there was a lot of expectation, and they did, as we can see here, climb to record highs during that period. Now, they do believe that the valuation is getting a little bit high. Market is slowing down in relation to this, and therefore they do believe there is better opportunity, and they have moved their money into other stocks. So that is something that we did want to bring to your attention, given the fact that this is something that did just get released yesterday. So let's jump into the metrics of this company. Dividend safety score 84, very safe. Now we do note the market cap over 100 billion, a mega cap company. Now, in terms of looking at the last recession, they did increase the dividend during the 07-09 crash. They had minus 1.2% sales. Now, this was above the average. Remember, it did come in at negative 12, and they did marginally beat the S&P, as we can see here, negative 46% versus the S&P, which did come in at that 55% negative level. Dividend growth, not too bad, 5% last October, so above the 4% inflationary rate we always advocate on the channel. 8% over the last 5 years is again fairly decent. Nice to know over the last 20 years though, double-digit increase to their dividends, and we can see 21 years of consecutive increases, so they are 4 years away from becoming a dividend aristocrat, whilst also paying dividends for the last 31 years without a reduction. Now, in terms of dividend yield theory, for those that are new, it does show that a company is undervalued when the current yield is above the 5-year average. So we have a small sign here of undervaluation. We do, however, note the forward PE does sit above the 5-year average. And when we look at the industrials average of 19.9, we can see Lockheed does come in slightly lower. It is also important to remember that all of these models that we do look at, we don't conclude on this company of any of them in isolation. Free cash flow payout below 60%. Remember, below 60 for me personally is my target. Let me know if you have anything that's different. If I see it below 60, it does give me faith that companies can offer those double-digit increases we love to see. And in fact, over the last 10 years, it has only gone above that once in 2018, 49% in 2023, 51% expected in 2024. So again, no real worries with their dividend safety. As we can see, it did get a very safe score. Free cash flow per share, well, $9.54 in 2014. Nice growth over the period. Yes, it isn't very consistent. Nonetheless, it is moving in the right direction. More than 2 times growth over the period as well. But as we mentioned, the free cash flow, similar to the earnings per share, is expected to drop slightly in FY24. In terms of the sales growth, well, steady, moderate growth, 3 to 7%. We can see pretty inconsistent. Some years where it is negative, notably 2014. Some years very strong double-digit growth in 2016, and some years where it is below, in fact, our 3 to 7% level in 2015 and 2022, or 23, in fact. But we do understand, on average, it does seem to be getting at that rate, and we see it has increased from around 40 billion to 68 in 2023. Now, as we mentioned, they are planning on doing more share buybacks in FY24, and we can see this is a company that does generally consistent buybacks, reducing the count from 322 million to 251 in the latest period. In terms of ROIC, very strong, very healthy, well above the minimum 10% that I look for, 36% in 2023. Now, these numbers are incredibly attractive for investors and potential investors, as it gives us faith that management are able to effectively allocate their capital. Now, in terms of the operating margin, we want to see above 12%. They pretty much consistently straddle around that, so no real red flag indicators, 13% in 2023. And what is nice to note is their free cash flow margin is above those minimums that we look for, pretty consistently around the 10% level over the last 5 years as well. Finally, the net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization, below 3 for the majority of companies. It has been pretty much below 3 since 2019, expected to be 2.32 in FY24. So it gives us faith, 1, about the balance sheet, which we did analyze earlier, 2, about the dividend, which in conjunction with the dividend payout ratio being quite low, does ensure us that justification of that very safe level. And for those that are new, these numbers effectively show the number of years it would take the company to pay off all of their debt net of cash on hand. So let's jump into the valuation. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And let's jump into the first model. We have Graham's valuation. We have the EPS, growth rate, as well as the AAA corporate bond yield. Now we get an intrinsic value on this of $305. Now with the market price around $450, we can see our first overvaluation signal. But do bear in mind, we don't look at any of these models in isolation. We then have the multiples valuation model, company in a similar sector and size, their PE. We get the average of that multiplied by LMT's EPS to get an intrinsic value showing some significant undervaluation, essentially showing us that Lockheed Martin does trade at a much cheaper PE ratio than some of its competitors. We then look at the dividend discount model with the yearly dividends. Now the growth has been fairly decent, around 7.5%. Forward looking, we have gone pretty conservative at 5.25. We then get a very marginal undervaluation signal at $482 versus the current value of $450. We then get onto the DCF model with the free cash flow year on year. Average growth rate 25%. Again, we do like to be conservative even though we are applying a margin of safety onto this as well. 5% below management target, below analyst estimates. With the discount rate as well, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get to an undervaluation signal of $505, showing then in today's episode 3 undervaluation signals and 1 overvaluation for LMT. Now, the intrinsic value in this case is purely the average of these 4 models, coming to $529. Now, don't forget you can grab a copy of this model by clicking in the pinned comments below, where you can get your own intrinsic value, your own acceptable buy price of companies, whether that's in your portfolio, those on your watch list, or if you just want to rerun through those that we have gone based on your own targets. Margin of safety then, as always, we do start off with 10% and we do execute on that if we believe it meets 3 criteria: a wide moat, strong financial metrics, and good forward-looking data. And then we keep going till it's near the current trading price, and we can see for today's episode it's pretty much 449.26, so pretty much right in line with the current price. So Lockheed Martin, ticker symbol LMT, has a 15% MOS based on our estimates and judgments. Now, in terms of Wall Street and their forecast over the next 12 months, they believe the share price will go to around $492. They see upside of 9%, and they do believe it to be a fair buy now. However, it does really depend on what you believe the future does look like over the next 5 to 10 years. As always though, do let us know your thoughts in the comments below. Is Lockheed Martin one that you are looking on your radar? Maybe you are waiting for it to drop further. We did review this around 6 to 7 months ago where it did drop down to the 400 level, but it has rebounded up and now is at the 450. So let us know your thoughts. Some people will be waiting for it to drop back down to the 400 level. Others will be looking to dollar cost average in. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.